Good day, subscribers, and welcome everybody back to the Contrarian. Today's recent CPI print has come out much higher than expected, and in fact is at a 30-year high. So I will get into that after I give one announcement, and that is that I will now be uploading my content to Rumble as well as YouTube. This is for a couple of reasons. First of all, a few of you have given me some feedback, just letting me know that you would really like to not participate, not really give any sort of funding to YouTube or to Google simply because of their ever more draconian measures on free speech. I'm also doing this simply because YouTube has recently been cracking down seemingly out of the blue on some other channels that are similar to mine. George Gammon's Rebel Capitalist channel was recently taken down, as well as Anthony Pompliano's channel. And this, if you know these guys, they weren't talking about any sort of content that YouTube was explicitly saying they could not. So as a way of diversifying my channel in a way, I will be now posting my content to Rumble as well as YouTube with the same name behind my channel of The Contrarian. So without further ado, I will now get into the official CPI report for the month of October, which, to put it mildly, came in a lot higher than expected, and the markets are really beginning to price that in. So I will now get into article from Bloomberg. Consumer prices soared 6.2% in October compared to last year, accelerating from September's 5.4% year-over-year rate. This was a bigger jump than the 5.9% rise anticipated based on Bloomberg consensus data, and it represented the fastest annual rise in consumer inflation since 1990. So it's now going back actually greater than the whole 2007 to 2010 short period of inflationary pressures we saw back then. It's now actually higher than that. Going on, the staying power and magnitude of inflationary pressures has become a critical question for market participants, with companies across industries reporting rising input costs and price hikes in order to pass on these expenses and preserve their margins. While third quarter earnings results have showed that S&P 500 companies have largely been able to navigate these cost pressures, the possibility remains that lasting inflation could exert a greater impact, especially if consumers ultimately prove unwilling to pay higher prices. Inflation data so far has reflected still elevated pressures in the recovering economy, even as Federal Reserve officials maintained that the supply-related factors creating these heightened costs would eventually wane. Tuesday's producer price index from the Bureau of Labor Statistics showed that prices paid to producers jumped by a marked 8.6% in October compared to last year. So companies are really beginning to pass these costs on to consumers, representing the fastest rise in data extending back to 2010. And last week's October jobs report showed average hourly earnings jumped 4.9% last month compared to the same period last year, accelerating from September's 4.6% annual rise. So my thoughts on this greater than expected CPI print, and with a way in which the market is finally kind of beginning to realize, I think, that inflationary pressures are very high right now. I would be on the long-term inflationary bandwagon for several reasons, and I know that not all of you agree with this. I've received some feedback from you just in terms of how you agree with how high current inflationary pressures are, specifically with supply chain issues, but you don't entirely agree with just the long-term argument of that continuing on for several years, if not, a decade from now, just being a long-term trend. I would highlight my reason for being on the long-term inflationary bandwagon for several reasons, one of which I would summarize just as the market finally having to catch up with the increase in prices with wage increases, and secondly, in terms of just not fighting the Fed and what the Fed has done and what they might do should another sort of recessionary type event occur. So first of all, just simply the actions of the Fed in response to the Great Financial Crisis and in response to COVID has really been to just put massive amounts of overall liquidity out there. So far, this has put inflation into asset classes as opposed to the overall economy. So we've really seen in the last 12 years we've seen mostly asset inflation and not as much actual real inflation out there. However, I do expect that as the economy actually does begin to recover, as consumers actually go out and spend, and actually as overall demographic changes begin to occur of millennials, my generation actually beginning to purchase homes, actually go out there and get professional jobs, have families, I would actually expect that to really begin to get inflation going again, and not just in the overall asset class. This would be for several reasons, but just mainly looking at demographics. The baby boomer generation has not been a major spending force. They've been a major owner of assets. They've put a lot of their money in assets in the last 10 years, but as would be typical for people who are looking to retire or who are retired, their spending just is not as high as it used to be. So this would potentially be an explanation as to why inflation has not been there in terms of just overall prices actually going up. But I do expect this to change as the millennials begin to enter the workforce, have families, purchase homes, etc. That will be a major spending increase, and especially with what we're seeing right now in terms of the supply chain issues and that causing an increase in wages, I just do expect that to continue into the long term in terms of the overall demographic change, which does take a really long time to occur. It's not a short-term trend, but I just do think that this initial response of the supply chain essentially crisis that we're having right now, of just not enough workers being willing to work. Speaking from where I'm living, for example, many of the fast food restaurants here are having to start at $20 an hour, and they're still extremely short of staff. They're just not having enough people willing to work for even $20 an hour. So, maybe a year from now, maybe they're having to start at $25 an hour. That would be a dramatic increase in wages, and then that would in turn be passed down to consumers. So that just goes to show how strong this short-term inflationary pressure is. However, this is a very complex issue. For example, I do expect in the next couple of years that there is some sort of sizable market correction, and that it actually could be a very volatile type of correction, just in terms of the amount of leverage that is currently in the financial system. I do expect that to be a fairly volatile type of correction when it does occur. But whatever that is, I do expect the Federal Reserve to respond to that in just the ways that they've continually done for the last 20 or more years, of simply printing more money, and if anything, giving more direct payments to consumers in an attempt to get them spending again. And this would be, even more fuel on the fire in terms of long-term inflation. The Fed really has one of two options at this point in order to get out of the debt to GDP conundrum that we are in right now, of roughly 130% debt to GDP ratio for the United States. They can either default on their debt, or they can begin to have inflation run much higher than nominal interest rates and eventually inflate away some of the debt to get that into a more manageable position. And so obviously the Federal Reserve would really not want to have to go with the default option, in terms of that would just make them all the most despised people in the country. People would not approve of that in the short term. Americans have very short memory these days, and so it would likely be whoever was the president and the chair of the Federal Reserve who would receive the most blame for such default occurring. And so they would really like to just keep this whole inflation going. They would love, if anything, to keep interest rates below that rate of inflation, and in that way they could actually do what was similarly done back during the period of the 1970s, where the debt to GDP ratio actually briefly fell, even though government spending wasn't cut significantly. Debt to GDP ratio fell just because inflation ran way hotter than interest rates for a while, and that in turn caused the debt to GDP ratio to actually be diminished. So I do expect that sort of a strategy to be used by the Fed, and so that is why I'm on the long-term inflationary type bandwagon. But now I will look into, or I'll just talk about the reaction of the markets to this news of the CPI print. And it is kind of what I've been expecting for the last 6 months to eventually happen in the market. And that is, I think that investors are beginning to realize that, maybe this whole transitory inflation argument is not actually what will occur. Maybe inflation stays around longer than the Fed is, saying. So in reaction to this, a lot of the, higher valuation companies out there in these indices have, experienced a initial sell-off as a result of this CPI print. Obviously, we'll have to see how long this goes on. Obviously, this is just the first day, but, the initial response of the market is, I think, what, should almost be expected from the market in terms of the most high-flying, high-valuation companies have experienced the most selling pressure, and the commodities and the, companies behind a lot of the more inflationary type hedges have actually been those which have received the most capital inflow. So, gold and silver miners have all rallied significantly as a result of this CPI print. And actually a lot of other commodity producers such as copper or platinum or other metals, steel, have also rallied as a result of this. So ultimately we will have to see how this continues to play out. I don't know if the market will continue to remember this whole CPI print in terms of just the market lately hasn't been having a very good long-term memory. Usually the market reacts to something and then a few weeks later kind of forgets about it. So we will have to really wait and see how this ultimately plays out. But all this being said, I do think the market is maybe beginning to realize that inflation is here to stay, and it's at least being a lot more sticky than the Fed would like to admit. So all of this being said, this is all I really wanted to talk about today. If you like this kind of content, which I talk about, which tends to be going against the crowd in order to outperform the markets, that's why I call this channel The Contrarian. You can just consider subscribing, and I hope to see you again at some point.